Examples of how selected professionals screen for favorable stocks. Different analysts develop different methods. So the first method is William O'Neill CAN-SLIM method. So what is CAN-SLIM? Let's first see that. C is basically current quarterly earnings per share versus a year earlier. So what is the comparison or the difference between the quarterly earnings of this year versus what it was a year back? And then we have A, which means annual earnings increases. And then we have new products management and stock price high. And then we have obviously the supply and demand, and then leader or laggard, institutional sponsorship, and market direction. So this is the CAN-SLIM method, and it is by William O'Neill, and this is one of the favorable method of selecting stocks. Okay. So we as technical analysts are not only concerned with LNM, which is leader and laggard and market direction. The other selection criteria are useful but not in the domain of this book. To determine L, leader or laggard, O'Neill calculates the 12-month percentage of the price change of every stock weighted more heavily than the recent 3 months, and ranks each stock in percentiles from 99 to 0, and 99 being the strongest. So that is how you find the leaguered stocks, leader stocks or laggard stocks, right? So that is by basically calculating the 12-month price changes and then seeing which one gave us the heaviest move as compared to the last 3 months, and then you are going to rank it in percentiles, and 99th percentile is going to be the highest. He has not divulged the exact formula, but as we know from academic studies and other, the exact calculation is less important than the look back time over which price change is measured. This method is on the long side at 12 months, about the time when a strong stock begins to revert to its moving average. The weighting over the past 3 months reduces the overall time for comparison and therefore improves the prospects of the price strength continuing. O'Neill found that the average relative strength percentile by his calculation was 87 before upward moves. For market direction, O'Neill refuses to listen to the newsletters and gurus and refuses to use the economic data because it lags behind the market, obviously. So, when you are using the economic data which is released, you need to keep one thing in mind: the price is always discounted, which means that the news which is being released in the market, that news is already there with the market, and the market has already accounted for that particular news. So, that is not a valid thing to see when you are trying to find the market directions. He has a number of specific indicators and patterns. He watches for signs that a market is bottoming. He believes that a buy and hold method is faulty because the widely held belief that all stocks will recover after a bear market is a myth. So this is the Williams O'Neill CAN-SLIM method, where C is current quarterly earnings as compared to the last one, A is annual earnings increases, N is new products, supply and demand, L is leader or laggard, I is institutional sponsorship, and M is market direction. Here, how to find the leader stock, that was the most important one, because you are going to calculate the percentage price change of every stock for 12-month period, and you are going to see which is weighed more heavily in the last 3 months, and then you are going to rank the percentile. Then that was the Williams method, and now we come to the James P. O'Shaughnessy method. So what is the James P. O'Shaughnessy method? Not surprisingly, James O'Shaughnessy, the president of O'Shaughnessy Capital Management in Greenwich, Connecticut, found in studying 43 years of fundamental price data, the most investment strategies are mediocre at best, and traditional investment management does not work. He studied market capitalization, price to earnings ratio, price to book ratio, price to cash flow ratio, price to sales ratio, dividend yields, earnings changes, profit margins, and return on equity. Basically, all the ratios. He found that relative price strength out of all the possible variables, fundamental and technical, was only growth variable that consistently beats the market. James P. O'Shaughnessy's calculation of relative strength is similar to O'Neill's in that it takes the ratio of the year end price to the price 1 year prior. So, when you saw the O'Neill's method, we saw that he was taking the ratio of the quarter as compared to the quarter 1 year back. But when we talk about O'Shaughnessy's method, he takes the closing price of this year with the closing price of a year earlier. Okay, so 12-month relative price. Now we comes to the Charles D. Kirkpatrick method. Now what is the Kirkpatrick method? He has long had a model similar to that of James O'Shaughnessy. The principal differences are twofold. First, in working with Robert Levy in the late 1960s, he discovered the importance of relating all ratios to each other. Thus, in using the stock price, he calculates the ratio of the closing price to the stock market's moving average and then ranks all stocks by their ratio. So, the method which is used by the Kirkpatrick is that he calculates the ratio of the closing price and then that with respect to the moving average. Okay, so closing price divided by the moving average and then ranking all of them, you get the Charles D. Kirkpatrick method. Okay, and then you plot it down and you are going to basically find the best fit, actual percentage and the market average percentages. So William O'Neill gave us the Cancelim method, and you know what Cancelim is. And when you talk about the leader, you are going to calculate the price, 12-month price change of every stock and see which is most weighted in the last 3 months. And then you have James P. O'Shaughnessy method. And when you talk about O'Shaughnessy method, what you understand is that he basically calculated all of the ratios. Okay, and he used the ratios in order to find the stocks. And then he also saw many screens. For example, if the price to sales is below 1.5, earnings are greater than previous year, and then so on. When we talk about Charles Kirkpatrick method, we saw that he was ranking his stocks by calculating the closing price, right, of 1 second. Yeah, here in Kirkpatrick we were talking about the fact that he uses the ratio of the closing price with the stock market moving average, and whereas in James P. Shaughnessy he uses closing price of this year with the closing price of 1 year earlier. So Kirkpatrick, I hope it's clear now, it's the ratio of the stock with the moving average. Alright, now we come to the value line method. Now, what is a value line method? The value line ranking system has an extraordinary history of outperforming the market. Value line claims that its timeless ranking system has outperformed the S&P. Although the company will not divulge its method of calculation, it does admit that a significant portion of it includes a calculation of the relative price strength. Other factors include earnings trends, recent earnings, and earning surprises. Value line charges a fee for its stock service. So, what is value line? It is again a it uses relative strength like all the other methods, but it is a website and they have not, obviously they charge a particular subscription. If you are interested, you can check out their website as well. Next, we have the Wyckoff method or the Richard D. Wyckoff method. So, I don't know if you guys know, but Wyckoff is a very, very, very famous person in the industry and he has contributed significantly to this industry. If you talk about the Wyckoff theory or the Wyckoff method, you can also remember that a lot of indicators are also named after Richard Wyckoff. A method of profiting from the stock market using technical analysis and relative price strength that has stood the test of more than 80 years is the method that has been taught by Wyckoff since 1931. Richard Wyckoff, now considered a legend and one of the most important proponents of technical analysis, began his career in Wall Street as a runner in 1888 and he was only 15 years old. He organized his own brokerage firm by the time he was 25. From his brokerage firm, he published a daily newsletter that evolved into the magazine called the Magazine of Wall Street. Motivated by seeing appalling losses, Anyway, this is just the story of Wyckoff. If you want to, you can read it. Wyckoff believed that strongly the stock prices were determined by supply and demand. That's what, whenever we even speak about the Wyckoff theory, the first thing which is taught in that concept is supply and demand, right? About how the market is always moving according to the supply and demand that is prevalent and present in the market. He had little use for tips, rumors, new items, earnings, financial reports, and so on. He was a true technical analyst and a successful one. He believed that the markets were influenced mostly by wealthy individuals and informed insiders. Substituting institutions today for these players, we find that the situation has not changed. By understanding what these capital pools were doing in the markets, one could profit by following them. Their capital moved the markets right or wrong, and the small investor could take advantage of this movement by understanding how to gauge it. Wyckoff's tools were many of the methods described in this books. He used charts called vertical charts and point and figure charts. So vertical charts are basically the bar charts which we had been seeing. He measured relative strength for both long and short positions, used volume as a means of testing, and so on. Support and resistance reversal points. So what are reversal points? Reversal points are known as danger points. Okay, and danger points basically mean that the trend could like basically now reverse and so on. Okay, he believed that attempting to fit the market into a formula or specific pattern was futile because no two markets are the same. He believed that these waves could be determined and anticipated. So the waves is the Wyckoff theory, and Wyckoff theory basically gave us a method using waves which you can use, and it is that waves are not just random waves; they are quite mathematical methods. Okay, we're almost done with the chapter. I'll just quickly go ahead. We just have this page and this page, so let's quickly do that. So, speaking of Wyckoff, to determine the direction of the entire market, Wyckoff devised an index called the Wyckoff wave that was a composite of the most widely held and active stocks. This was his proxy for the market. Preferably, the stocks in the index were the ones that the investor or traders were interested in trading. His concept of trend was to watch trend lines drawn on the wave chart and on the charts of the composite market. To select stocks in harmony with the market, Wyckoff selected stocks that were strong in upward trends and weak in downward trends. He believed it was futile to act against the trend. His calculation of relative price strength used the percentage changes from wave highs to lows and lows to highs of each stock versus those of the Wyckoff waves. Those stocks that constantly outperformed in each wave in direction were the ones to analyze further. So that was basically his method of selecting the stocks, right? How much percentage it changed with respect to how much percentage the wave has changed. To determine the potential of these selected, Wyckoff used the point and figure horizontal count. At the same time, a stop level was established, and for the stock to be considered further, a 3 to 1 of potential gain is also there. To determine if the stock is ready to move, shorter term considerations were needed to analyze the nature of its price action. To do this, Wyckoff relied on volume, range, and momentum. To time the entry, Wyckoff based his decision on turning in the overall market. His basis for this principle was that the most stocks move with the market direction, and timing with the market changes reduces the risk of error. So this is what is the Wyckoff theory. Now let's just conclude this chapter. Trading is often focused on few issues because each must be watched closely and intently. Selecting the issues most suitable for a trader depends on many factors having to do with the trader's time horizon, liquidity, volatility, and the preferred market. Technical methods, operating costs, and risk tolerance. Those traders who look for special opportunities in the market rather than concentrate on small number of issues are often seen as swing traders who hold their positions for a few days. They use screen based principally on technical actions such as patterns, gaps, breakouts from prior highs and lows, and changes in the volume and volatility. Their equipment is able to scan through a large number of issues looking for such indications or trend change, as might be expected. In investment selection, as in fundamental screening for issues, technical screening can begin with the overall picture, the top down approach, or it can begin with the individual issues, which is the bottom up method. Okay, so that's it with this chapter. This was quite long and it can be quite theoretical in nature, but it is a very important aspect in the exam. Thank you.